Hey guys, welcome back to another episode. In this video we will be going through our high probability double top and double bottom trading strategy in depth and how we use it in combination with price action. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. One of the most powerful reversal patterns in any market is the double top and double bottom reversal pattern. And it's one of the most lucrative reversal patterns because they signify the start of a new trend. However, while double top and double bottom can be very lucrative, there are also many false reversals. So, you definitely do not want to get into a trade every time you see a double top or a double bottom. You only want to pick the ones that have the highest probability of working out. So the question becomes, how do you know exactly which double top or double bottom reversal pattern to trade? And that's what I'm going to share with you in this video. And now, what is double top and double bottom? The double bottom and double top patterns are powerful technical tools used by traders in major financial markets including stock and forex. The double bottom pattern entails two low points forming near a similar horizontal price level and signifies a potential bullish reversal signal. A measured strengthening in price will occur between the two low points, showing some support at the price lows. The double bottom chart pattern is found at the end of a downtrend and resembles the letter W. Price falls to a new low and then rallies slightly higher before returning to the new low. Unable to push price to a new lower low to continue the downtrend, sellers give up and price bounces sharply from this area. The bullish confirmation is specified by a break in the key price level situated at the high point between the bottom's resistance level or neckline. Similarly, the double top pattern reciprocates the double bottom pattern, signaling a bearish reversal. Instead of the confirmation being shown at a break in the key resistance level, the double top occurs at the key support lows between the two high points. Identifying the double top and double bottom formation on a chart. Double top chart formation. The double top technical formation starts with a bullish trend. The trend gets interrupted at some point and the price of the asset starts to range. The range consists of two swing tops on the chart. After the creation of the second top, the price action drops and starts a new bearish trend. Notice that the initial trend is bullish, but later it gets reversed after the double top formation. Double bottom chart formation. The structure of the double bottom technical formation is absolutely the same as the double top pattern, but upside down. The double bottom chart pattern starts with a bearish trend, which gets interrupted at some point. The price action then enters a range, which creates two bottoms on the chart. After the second bottom, the price breaks the range to start a new bullish trend. Confirmation of double top and double bottom. Although the pattern is fairly easy to recognize and can be traded using a basic set of rules, you cannot simply jump into a trade whenever you see two bottoms or tops on the chart. To initiate a trade based on this pattern, you should first confirm its validity. There are two details related to the confirmation of the double top and the double bottom reversal patterns. This includes the neckline and the breakout. The neckline. The neckline of the double top pattern is the horizontal level at the bottom between the two tops. Opposite to this, the neckline of the double bottom pattern is the horizontal level at the top between the two bottoms. The first thing you need to do when you spot the pattern is to manually add the neckline on the chart. It plays the role of a trigger for your trade. Therefore, this level is of a great importance for your pattern. The breakout or the neckline breakout. The confirmation of the pattern comes when the price action breaks the neckline. Closing a candle beyond the neckline means that there is a valid breakout of the range, which comes after the initial trend. Since the breakout is opposite to the trend, we confirm the emergence of a new trend. If you have a double top pattern, you will wait for a bearish breakout. If you have a double bottom pattern, you will wait for a bullish breakout for your confirmation. Then you would trade the pattern in the direction of the breakout. Potential of the double top and double bottom reversal patterns. How to identify a potential target for a double top and double bottom pattern. First and foremost, any potential target should first be identified using simple support and resistance levels. This is true regardless of the price action pattern that is formed. Having said that, there is a way to identify a potential target when trading a double top and double bottom pattern. It's called a measured move or a measured move objective, and the concept is easy to understand. There are two things you need to do in order to identify the minimum potential of your double top and double bottom chart pattern. First, size of the double top and double bottom reversal patterns. You need to measure the size of the pattern. To do so, connect the two tops or bottoms with a single line. Then add a vertical line to the line between the two tops or bottoms starting from the neckline. This distance is the size of your double top or bottom pattern. It works the same way with the double bottom pattern, but in reverse. Second, projecting the move. After you measure the size of the pattern, you need to apply this distance starting from the opposite side of the neckline. In other words, your first or minimum target equals the size of the pattern. Again, the same is in force for the double bottom figure, but in a bullish direction. And now, how to trade double top and double bottom reversal patterns. To trade double top and double bottom properly, you need to implement some basic trading rules. The following steps will help you identify and trade the double top reversal. Step 1. Trend identification. The first thing you need in order to identify a double top pattern is a bullish trend. You cannot confirm the pattern in the absence of a trend. Although tops and bottoms can and do occur when the market is not trending, a valid double top and bottom formation must exist in the context of a trend. Step 2. Creation of a top. Each top within a bullish trend could be the beginning of a double top pattern. Therefore, you should carefully observe the price action at swing highs on the chart. Step 3. Trend interruption. To continue with your analysis, you need to see the price action interrupting its current trend. Typically, this would come in the form of a price retracement that breaks the bullish trend line. Step 4. Creation of a bottom. After the top is created on the chart, the pattern needs to create a bottom. Many times, this bottom could be located below the bullish trend line, but that is not a requirement. Step 5. Creation of the second top. After a bottom has formed, the price action needs to create a second top on the chart. This is often referred to as the retest. The perfect double top pattern will have a second top, which is slightly lower than the first top. This indicates that the trend is at least slowing down and likely exhausted. Step 6. Drawing the neckline. The sixth step of our trade identification process is to plot the actual neckline of the pattern. To do this, you need to reference the swing bottom, which is located between the two tops. Then you would draw a horizontal line at this level. This would be the double top neckline. Step 7. Neckline breakout. The next step is to confirm the validity of the pattern. If the price action closes a candle below the neckline, we confirm the validity of the formation. Step 8. Trade entry. Since you have a confirmed double top pattern on the chart, you now have the go-ahead signal to enter a position. For the double top, you would open a shorter bearish trade. Step 9. Stop loss. You should always secure your open trades with a stop loss order. Although the success rate of these patterns is relatively high, there is never a guarantee that the trade will work in your favor. The optimal place to put your stop loss order is just above the second top of the double top reversal pattern. Step 10. Size of the pattern. Now that you are short based on the double top pattern, you need to project a possible target. You should measure the size of the pattern as discussed earlier and then apply it downwards starting from the neckline. This would be your first target or minimum target. Notice that this 10-step process works absolutely the same way with the double bottom reversal. However, the rules are applied in the opposite direction. Here are other examples of double top and double bottom trading strategy. Conclusion. Double top and double bottom can be without a doubt powerful reversal patterns. But you only want to pick the ones that have the highest probability of working out. As always, if you learned something new or felt it was helpful for you, make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time.